Hello and welcome to this first lecture on regulatory and ethical considerations in this course, Finance and Accounting Fundamentals. And in this lecture, in this section of three lectures, we will give you some good in-depth view of the regulatory environment and the regulatory considerations that you have. In this particular lecture, we will talk about the financial regulations and the regulatory bodies. How do they provide that regulatory environment? What are the prominent laws that you need to be aware of? So, what do you think? What are the laws and regulations governing financial markets and security, including the SEC and FINRA laws? Any thoughts? So, laws and regulations governing financial markets institutions are designed to ensure stability, transparency, and fairness of the financial systems. And that protects the investors, consumers, and economy from systemic risk and abuses. Now, obviously, these laws vary by the country, but they share a common principle. Now, let's take a overview of the most prominent laws and regulations. So first one is the Securities Act of 1933. And in all these laws that we're going to take you through, we will talk about why they were formed, how they work, and then we'll talk about an example to illustrate. So Securities Act of 1933 requires that investor receive significant information about securities offered to public sale for public sale to eliminate fraud and misrepresentation. Now, how it works? Companies offering securities to public must file registration statements and provide a prospectus. And this is there in all the countries, and definitely I know that for India. Now, this ensures transparency in financial markets, giving investors access to facts that they need. An example of that: any company offering new stocks or bonds to the public in US must provide detailed financial information through this regulation. And parallel exists of this regulation in all the countries, and I'm aware definitely of India. The second one that you need to take a look at is the Securities Exchange Act of 1934 in US. The purpose of this is that this governs secondary trading of security. Primary is what is sold by the floater of the stock and bond, and then people keep buying from each other, and that's a secondary trading. And for that, this government created the Securities and Exchange Commission to enforce the federal security laws. Now, how does this work? This imposes requirements on reporting of financial information in insider trading regulation. Insider trading means the stock trading by the people who are inside the company and who are privy to some of the information in advance. And this act ensures continuous disclosure of financial conditions by publicly traded companies. How does this work? And as an example, insider trading cases are investigated and prosecuted under the authority of the SEC thanks to this law. Then there is a Dodd-Frank Wall Street Reform and Consumer Protection Act US. This was enacted in response to 2008 financial crisis, and it aims to reduce risk, increase transparency, and protect the consumer. How does this work? Uh, this has introduced new rules and regulations for banks, hedge funds, and financial institutions, right? And they have created what is called CFPB, Consumer Financial Protection Bureau, and Financial Stability Oversight Council, FSOC. Now, these provide stricter regulations for derivative trading and impose higher capital requirement on banks. As an example, a bank deemed too big to fall are subject to security and stress test to ensure that they can survive future market conditions. So that's how this act particularly protects. Then let's take a look at another law called Basel III. It's an international, And there the purpose is that an international regulatory framework for banks is developed by the Basel Committee for Banking Supervision to strengthen regulations and the risk management of the banking sector. Now, how does this work? It imposes stricter capital requirements and introduces new liquidity requirements and ensures that the banks maintain right amount of capital to get passed through any financial stress. Now, the banks must hold more liquid assets, and that reduces the risk of bank failures during a financial turndown. The biggest risk with the bank is runoff, where people want to withdraw their deposits. And if you have enough liquid assets, you can go through that stress. Then, of course, the familiar Sarbanes-Oxley Act of 2002, which we have taken a look earlier. The purpose of this was it was passed in response to financial scandals like Enron, WorldCom, and it increases the accountability of corporation, particularly in financial reporting. It mandates internal controls and requires CEOs and CFOs to certify the accuracy of financial statements, as we saw earlier. And also, it introduces penalties for misleading, fraudulent financial activity. Public companies must establish more robust internal control and face stricter penalties for inaccurate or fraudulent reporting. Then there are Financial Services in Market Act 2000 of UK. And this regulates the financial services and markets in UK, covering issues like financial stability, consumer protection, and market integrity. And it works by creating it has created the Financial Conduct Authority (FCA) and Prudential Regulation Authority (PRA) to regulate the financial market. And these things ensure fair competition, protect consumer, and maintain confidence in the UK financial system. As an example, financial services company in UK must comply with FCA regulations to ensure that they act in the best interest of consumers. Then there is a Glass-Steagall Act repealed in 1999 in US, and this was originally it has originally separated commercial and investment banking activities to prevent conflict of interest and reduce risk. And it works by prohibiting banks from engaging in both investment banking and commercial banking activity. And as an example, before its repeal, a bank could not take deposits and simultaneously engage in high risk investment. Then there is AML. We have in India also an equivalent of that anti-money laundering law. These were designed to prevent illegal activities such as money laundering, tax evasion, and financing of terrorism through the financial system. And this works by making sure that financial institutions are required to implement compliance programs, including customer due diligence, known as customer or KYC, know your customer or know your or KYC process, and the suspicious activity reporting. As an example of this, the banks must verify the identity of their customers and report any transaction that seems suspicious or unusually large. So that's how the anti-money laundering law works. Then there are European Market Infrastructure Regulation (EMIR) for EU. Now this regulates over-the-counter (OTC) derivative markets and ensures stability and transparency in financial institutions trading these instruments in the European Union. And it works by requiring that of reporting of the OTC derivative transactions and central clearing for certain types of derivative. It also provides additional oversights and reduces system risk. An example, a company trading derivatives in EU must report these trades to the trade repository as a part of regulatory requirement under EMIR. Then there's a Walker rule in US, in which it's a section of the Dodd-Frank Act. The Walker rule restricts banks from engaging in proprietary trading for their own profit, and from owning hedge funds or private equity funds. It limits risky activities by banks, ensuring they focus on traditional banking services and avoid speculative investment because that's where the risks are. As an example, a major bank is prohibited from using customer deposits to make speculative investment, which helped mitigate the risk leading to the 2008 financial crisis. Then there is a Payment of Services Directive 2 PSD2 for EU. And this regulation is aimed at creating more integrated and secure payment systems across EU. And it works by mandating stronger authentication requirements for online transactions, encourages competition by allowing third-party financial service providers to access the data of the bank's customers. And as an example, European fintech companies can now offer services like payment processing and account information through opening banking under PSD2. Then there is Graham-Leach-Bliley Act (GLBA) of US. The purpose this requires financial institutions to explain their information sharing practices to consumers and protect sensitive data. And it works by mandating that institutions provide customers with privacy notices and options to opt out of information sharing with the third parties. As an example, banks and financial and insurance companies must inform customers about how their personal data is being used and offer privacy options. So, in conclusion, laws and regulation governing financial markets institutions are critical to maintain market integrity, ensure fair practices, protect consumers and invest, and prevent system risk. Financial institutions are required to follow these guidelines to foster confidence in the financial system and mitigate the risk of financial crises or abuses. So, what do we do next? Having looked at regulatory environment, we will look at ethical considerations, starting with the corporate governance. So, thank you so much for watching this first lecture on regulatory and ethical considerations for finance. And I hope you continue to learn new things, continue to enjoy. And I do look forward to see you again in the next lecture. Please feel free to message me if you have any questions. I'll be happy to answer your questions. And do download the PDF file to read through any of these things that you need to.